unique
We're on.
strategies
Let's
that
go.
Barry has.
So, hey, we're super excited.
In the industry.
We're not.
This morning, I cited Barry Habib, who's had an outstanding record as the mortgage interest rate follower.
I'll tell you something, I'm not too good to wash my hands. I try and learn every single day.
That's a big number. That's the number that Barry Habib called for and all of Art Cashin's followers have been looking for quite a while. See if it holds. That's a big deal today.
Who, though, would have predicted our 10-year yield would have fallen below 0.5%? Last Thursday, the Clayman Countdown brought in mortgage expert Barry Habib. Hope you guys were watching, because here's what he said.
I think the bond market in the 10-year goes to about 0.5%. Very realistic, in my opinion.
Boy, was he right.
And this man knows more about real estate, markets, interest rates. If you want to be prepared for what's coming.
All right, guys, so listen, where are things going? Where are we headed?
Do you know what motivates you? And do you know what motivates the people around you?
That's awesome. We are so excited to have Barry Habib here with us today and get the honor of introducing him. He is the CEO of MBS Highway, an American entrepreneur and a frequent media resource for the mortgage and housing, for his mortgage and housing expertise. He's an Amazon #1 best-selling author for his book, Money in the Streets. You can see the poster behind him there, which is awesome. He is a director on the Fannie Mae board, which is something that is really near and dear to us in the industry to have his voice heard there. He's widely credited for saving the mortgage industry in 2020 from margin calls due to the Fed actions. His presentation to the Fed at that time created stability at a very, very critical time. He has got a ton of awards, and we'll highlight some of them today. In 2024, he was the Crystal Ball Award winner by Fannie Mae, Pulsenomics, and Zillow for the most accurate real estate forecasts out of 150 top economists in the U.S., which marks his fourth in 7 years, which is incredibly impressive. In 2019, he's a Mortgage Professional of the Year. He's a finalist for the Ernst & Young Entrepreneur of the Year. He was named to Mortgage Global 100 list. In 2024, he's this Distinguished Industry Service Award by the NAMB. And he got the St. Armand Ventures Businessman of the Year in 2021. He was named to the list of the 100 people to watch in 2023. And during his mortgage career, Barry personally originated over $2 billion. So he understands the market and understands what it's like to be out there in the loan originator's shoes. So he's a lead producer of a managing partner of Rock of Ages, which you can also see that poster behind him, which is the 27th longest running show in Broadway history, which he also took around the world and turned into a major movie starring Tom Cruise. He's produced Chris Angel's Mind Freak at Hollywood in Vegas, and he is the highest rated speaker and trainer for over 25 years in the mortgage and real estate industry. Barry, we're glad to have you here. And Brian, you want to share some words of welcome with everybody?
Yeah, welcome, Barry. It's great to have you. Great to see you again. And I just want to thank you for being such an advocate for our industry. And we look forward to hearing what you have to say about this year's forecast. So thanks. Great to see you, buddy.
Well, you guys are so kind, and it makes me so happy every time I'm here. Well, first of all, I think we need to give kudos to Thea Chambers, because she set the mood with "Let's get down to business," man. I thought that was a great pick, Thea, and she's in the background, but she always does such a great job, and I really appreciate all of you guys. Bill, so good to see you. Emily, Brian, you guys are looking amazing. All of you wonderful people that are taking the valuable time out of your day. I am completely honored to have the privilege to share some time with you. So, when the Atlantic Bay family calls me and wants me to come on, it's something that I consider to be a privilege and an honor. And I will tell you, this is the absolute truth. You could ask my teammates Diana and Tori, because as we were putting this together, you have to decide, for this presentation, what are we going to put in and this and that. And sometimes we say, okay, is this a little bit too sophisticated? I said, no, these people are some of the smartest people. This audience is some of the smartest audience. So we want to put stuff in there because they'll get it. And I promise I'll present it in a way that that helps you gather it. So I know that a lot of you are at watch parties. Thank you for doing that. And the main thing today is this. Look, we all have this thing kind of tugging at us and pulling at us. And because the stuff we're going to talk about today is sophisticated in nature, and I promise to break it down in a way that you'll understand it. You do need to be engaged and focused, but I also want you to take notes because I don't want you to just consume it. I want you to be able to teach it. You have to be the resource because there's a wonderful opportunity that exists right now in housing for buyers. They shouldn't miss it. And there's also opportunities in refinancing that we have to prepare ourselves for. So it's kind of, there's a lot out there for both people on the mortgage and real estate side to help their customers take advantage of it. So if it's okay with you, we're going to jump right in because we're going to talk about what to expect for the rest of 2026. I can't believe we're closing out February already. Where does the time go? But I think that this is going to be an incredibly positive year for us. It's definitely already started out with some improvements on a year-over-year basis. If it weren't for the weather messing us up a little bit, things would even be better. But let's hope that kind of leaves us. This has been a tough winter if you're in the Northeast. I go back and forth. Right now I'm in Florida, but I'm very oftentimes in Jersey, and boy, it's ugly. I'm looking at my cameras back home from Jersey. It doesn't, it's a lot of snow piled up. So, okay, let's get right to it. I'm going to share some slides with you. I'm going to do it in a way where you could still kind of see me. So here. So the title is the forecast for a strong 2026. But really what we want is, and what I really want is, I want you to be able to make the most of the opportunity here. So loan officers, so many of the top producers reside within Atlantic Bay, and that's just a testament to Brian and leadership there. I mean, you guys do such a great job. There's questions, how many loan originators are there in the United States? Well, it's 171,000. Real estate agents, there's about 1.4 million. There's a lot more real estate agents out there. But of the 171,000 loan originators, the median production in 2025 was $4.6 million in loans. That means half the originators did less than that. Now, in the top 25%, 12.3, top 10%, 25 million, top 5%, 37 million, top 1%, 74 million. But kudos to Atlantic Bay. And again, it's the leadership, because you guys are near the very top of this, and it's deservedly so. It's because you are very educated, you have great leadership, and you have great resources at your disposal that help you excel in these ranks. Now, as we talk about the 2026 forecast, let's just take a step back. Let's see, hey, how did we do last year when we did this together, right? So I got the slide from last year, and let's see. I think we did okay. Wasn't perfect, but I think we did okay. So in 2025, we said, hey, the 10-year Treasury. Now, remember that the 10-year Treasury was like at 4.6, and we said it was going to go down to 3.8. It was like, wow, that's a big move. It got to 3.89. So we were close. We were certainly in the neighborhood. 30-year fixed rate mortgages. Now, remember, they were at 7.25. And I said, hey, I think we can get to 5.75 and 6. And a lot of people say, well, I don't know. We got to 6.1. And you might have seen just recently, we did dip below 6. So we were pretty darn close there. I'm not going to say it's perfect, but I'm happy with that. As far as mortgage spread, this one we definitely dialed in. The mortgage spread was at 2.8%. And just if you're not familiar with the term, you have the 10-year Treasury, and then how far above the 10-year Treasury is a 30-year fixed rate mortgage? That's known as the mortgage spread. So that was at 2.8%. We said we think that compresses to 2.25. And I will talk more about this later, and I will explain how it works in a way that most people don't understand it. They talk about it, but they have no clue what it is. But we will make sure that you are an expert today on this. It got down to 2.2. So I'm going to say that was close to a bullseye. The home price appreciation, we were a little aggressive, saying 3.5%. It came in, depending on where you look, there's different measuring sticks. Some measuring sticks say 1.5%, some say 2.5%, some say 3%. So Pulseonomics, Zillow, and Fannie Mae say 3%. There's different ways to look at it. But Redfin says 2.8%. So it was around 3. Unemployment rate, I'm very proud of this one because it was at 4.1. We're the only ones that said it should hit 4.5%. It's backed off a little bit, but it did hit 4.5%. That was our target. Not one Fed member saw it going there. So kind of proud of those numbers. Okay, well, past performance is not a guarantee of future results, but we're going to tell you what we think. Now, when I go through this, what I'd like to explain is that, the methodologies that we use, I think, have merit. So as we go through these forecasts, I want you to have confidence in saying, while there's certainly not a guarantee, there's reason to believe that we could be pretty close once again. And therefore, as you plan your business and as you advise your customers, we can give them good, solid advice. So let's first talk about inflation. Inflation is always important because inflation is a factor that drives interest rates. Think about it. If I were paying you a mortgage and you're receiving payments every month that are fixed, well, your shopping depends, and the buying power depends on how much inflation is eating away at it. So if you expect inflation to rise and eat more of it away, well, then you have to protect yourself, charge a higher rate so you can collect more money to offset the inflation. But if you think inflation may be going down, well, then you could get more aggressive in the interest rate you charge and take less because your buying power would be preserved. So that's why inflation is important. So as we look at it, the measuring stick that the Fed prefers is called PCE. That stands for personal consumption expenditure. There's also CPI, the Consumer Price Index. It is also very important, but the Fed tends to use as its as its most important measurement PCE. They want PCE to be year over year at 2%, but that's on something called the core. See, there's two measurements. There's the headline measurement, which includes everything, and they use 80,000 data points. And then there's the core, which takes away food prices and energy prices. Now you might say, why are you taking away food and energy? It makes sense. We need that. And of course, you'd be correct. However, what occurs is that the Fed says we don't think we can influence food prices. Weather conditions can do that, and energy prices. Heck, tensions in the Middle East or geopolitical events, OPEC, that could affect energy prices. And it wouldn't matter if we cut rates or raise rates. That's going to not be influential. So they say, if we remove food and energy, then we can have an influence over the core. And that's why they look at it. They want it to be 2%. And currently, these numbers are coming in higher than that. The shelter component is very, very heavily weighted. So the shelter component makes up 18% of this. And then as we look at what goes into shelter, it's rent, and it's something called owner's equivalent rent. The problem is the way the government measures it is it's old. It's 41 years old, these numbers. So because it's 41 years old, we're looking at numbers that we're looking at methodologies rather that go back to 1985 that don't bring this up to speed. So it tends to lag. And here's an example. The rental market, which goes into shelter, it's made up of new rents and renewals. New rents, I've got a vacancy. Renewals, someone's living there and they're going to renew. Now, renewals go up at 3% a year. And that's because, hey, it's a pain in the butt to move. It's expensive to move. So the landlord's got a little pricing pressure. But right now, the new rental market, there's a vacancy rate of 7.4%. That's the highest that we've seen on record. And then we have, those vacancies, because they're vacant, landlords are willing to say, hey, I'll take a little bit less. And in fact, those are going down at 1.5% a year. So since new rents make up 40% of the market and renewals make up 53%, when you weight the average of the two, so 53% of the market's going up at 3%, 47% is going down at 1.5%. The average is that really rents are going up at 0.9%. But the government's telling us that it's going up at 3.3%. That's a large overstatement. And when you factor it and multiply it by the fact that 18% of core CPI or core PCE rather is shelter, well, then you're looking at an overstatement of about 0.4 to almost 0.5%. And this is important because as the Fed is hand wringing over saying inflation's way, way too high, they're not looking at the real levels of inflation. And there's another thing that the Fed doesn't understand, and that is tariffs. And it's because tariffs are different than inflation. See, inflation looks like this. Inflation's like a staircase. It goes up every year, staircase every year, every year, every year. And what we see is that that's to be expected. But tariffs, it's a one-time price adjustment, and then it stops. Kind of like one step, and then there's no more. Now, I know we just got the Supreme Court ruling, and we have to see how that plays out. But the tariffs that were instituted last summer, as this summer rolls around, well, then we're not going to see that. So that might reduce the year-over-year inflation readings by another 4/10. So we're probably a lot closer to the Fed's target. Now, I think that inflation on a year-over-year basis will start to come down, but it's lagging and it takes time. But if we get under 2.5% in the numbers that the Fed sees, they'll be uh, I guess, hesitant to be as negative on inflation. The bond market should like that. They may be more open to rate cuts. So I think that'll be a plus. Now, look, there are measurements of this that are actual real-time measurements. And that's trueflation. Now, trueflation looks at 10 million data points more in real time, as opposed to the government, 80,000 data points with these lags. Now, what trueflation is telling us is, hey, we're not at 3%. We're at 1.5% on PC. And as far as CPI goes, which is more heavily weighted with rental in data, that's going up at less than 1% a year. So according to the more updated and more broad-based data, inflation is not that worrisome. The problem is, team, is that, we hear this, and a lot of it's a political football, because they'll say, oh, prices haven't come down, this and that. People are paying at the supermarket and they're feeling pain, and they are. But that's because inflation, while the rate of inflation is coming down, that's adding on to the inflation that's already being felt by consumers. So they're not saying, okay, prices are coming down, even though the rate of change is coming down. People don't feel it. So it still hurts their buying power because inflation is cumulative. So let's understand how that works. Now, there's also the job market, which is really important. And the labor market is very important as well, because the Fed's mandate is for both inflation and the job market. Unfortunately, we haven't been getting the most accurate data on jobs, have we? And as you recall, last year, we told you that we felt that the labor market data was highly questionable. And as it turns out, we find out from the revisions that indeed it was very, very much out of touch with reality. Now, one of the things that people hang their hat on is the low initial jobless claims. We just got that today. You hear it on the media, people saying, look at the low jobless claims. Yeah, it's a low hire environment, but it's also low firing. And because we're seeing low claims for unemployment, we should take that as gospel that people are not being let go. I think what they miss here is that their thinking is not up to date. They're thinking about pre-pandemic. What's changed since then is we have what's called a gig economy. Look, the median income of a household is close to $90,000. And now, if you lose your income, and if you were earning $80,000, $90,000, $100,000, to file for unemployment benefits and get $300 or $400 a week would help, but it's not going to make ends meet in many cases. Most Americans don't have too much buffer in savings. So if I work like I can to help make ends meet by doing Uber Eats or Lyft or Uber, DoorDash, then I can help make ends meet, but that disqualifies me for filing for unemployment benefits. So I think that the low level of unemployment benefits is being misunderstood because our economy is so dynamic today, and people do have other options that were not as available 4, 5, 6 years ago. The reason why, when you call an Uber and it takes like 4 minutes to get there, or you order DoorDash and it's literally at your door delivered in 15 or 18 minutes, is because you have an army of people that are available to do this type of work. But we're also seeing continuing claims being troublesome in that once people lose their jobs, they are unable to find work longer. And here's another chart. They say a picture paints 1,000 words. And I think this does. The amount of job openings. I mean, just look at this. When people say that, hey, the job market is really healthy or really solid, I think that they're ignoring the fact that job openings are plummeting. And here's another thing you should know. The way that the job openings calculation occurs is very interesting. See, job openings are not tabulated by the government on a federal level. It's tabulated by each state, and then it's added together, to give you the total amount of job openings in the country. But why should we think about this a little differently since the pandemic? Well, as you know, there is now more prevalence of work from anywhere. So if you have a job that can be done by people at home, and there are so many of them, why would I limit myself to posting that job opening in just one state? I might post it in 7 states or in 6 states or in 12 states. Each of those states counts it as a job opening. So therefore, even though this number is so much lower, I firmly believe that it is very overstated as to the true amount of job openings. It's a shame that many Fed members don't look at this. Some do, some that are really smart do look at this stuff. But unfortunately, there are Fed members that either just are not trained in this, or look, you have to believe that there could be other motivations why they don't want to look at what's for real. Now, private payrolls, that's measured well by ADP, the payroll company. They do, 20 million payrolls. And as you can see, that's gotten very weak. This is telling us that the amount of jobs that we're creating, the red line 0, is look how many months of late have been actual negative job creations. And then we've got, of course, the BLS, which have been unreliable. But even though they're unreliable, they're showing just 15,000 job creations per month in 2025. That's after some revisions. There's more revisions to come. It wouldn't surprise me to see the 2025 overall number to be negative. But you could see a lot of negative reports. The job market, I don't know how people could say it's so great or solid. It doesn't look that way to me. And then look at the history of the BLS, what they've told us. First in the past year, they told us that we got 1.9 million job creations. That seemed great. 160,000 jobs a month. And remember now, if you're in the mortgage business, or certainly as a real estate agent, as those job reports come out that showed so much strength in the labor market, that could cause wage pressure, inflation, and interest rates tended to rise during those reports. But the BLS later on came out and say, oops, sorry, we missed it. We missed it by a lot. It was 1.5 million. Oops. But unfortunately, the bond market doesn't respond to old news. And so those poor people wound up paying higher rates. Now, there is the quarterly census of employment and wages called the QCEW. They actually go through this painstakingly and tell us what the real numbers were. So, okay, BLS, you came out with your initial survey, your revised survey, but what was the real number? Well, hold on to your hats for a minute, because it wasn't 1.9 or the revised number of 1.5. No, it was 420,000, not 1.9 million. So every 5 jobs that they told us happened, 4 of them never happened. And even after their revised number, 3 out of 4 jobs never happened. That is unfortunate. And a lot of that has to do with something they call the birth-death model, which is the way that they try to model how new businesses are created and how many jobs there are in businesses that shut down and how many jobs would have been lost. I believe that these antiquated methodologies from the BLS, boy, I sure wish they would get overhauled, both on the inflation and labor side, because this sure to me seems like we need to be doing better. As far as the unemployment rate, this is another survey that's got its holes in it, but it currently shows 4.3%. It did hit 4.5. I think that we'll reach 4.8% this year as a unemployment rate. Now, the Fed looks at all this, and the Fed's very important to us because the Fed does have an impact on mortgage rates. Now, some people in the media, they get this wrong, and they say, you know what? The Fed doesn't affect mortgage rates at all. In fact, when the Fed cuts rates, mortgage rates have gone up. So we don't want the Fed to cut, right? Well, I think they get it wrong. There is a definitive correlation that I will show you. But when we look at the Fed funds rate and its relationship to mortgage rates, we have to think about the fact that mortgage rates don't respond when the Fed cuts. They respond when the Fed tells us they're going to cut. See, the market looks in advance. So if we were to look, I'm going to show you a chart coming up. You'll see a blue line, that's the Fed funds rate, and a green line is at the same time mortgage rates. So if you look at this Fed rate cut here, that was a 50 basis point cut. And to someone in the media that is not trained, or maybe that has reason to want some clickbait, they'll say, yeah, the Fed cut rates, But then mortgage rates after a little while went up. So that means the Fed cuts rates and mortgage rates went up. Well, that's not the right way to look at it. What we have to look at is, when did the Fed tell us they were going to cut rates? And they told us right here they were going to cut rates. And look what happened to mortgage rates. In fact, in advance of the 50 basis point rate cut the Fed told us about, mortgage rates slowly started coming down, exactly 50 basis points, from 6 5/8 to 6 1/8 to the time of the Fed cut. And then they stayed there. But then what caused them to go up? The date of this was October 4th. So why did they go up? Well, they went up because the BLS told us that we had a blockbuster job report and it was going to be wage pressure inflation. The bond market didn't like it. The Fed started talking negatively and mortgage rates went up. Now, of course, later on, we knew that 200 of these 254,000 jobs never really happened. But unfortunately, this is the system that we currently have. Now, to show you the relationship longer term, let's go back through the 1960s even. And as we go back from the 1960s on, you can clearly see the blue line being the Fed funds rate and the green line being mortgage rates having a pretty close, not exact, but a pretty close correlation to, as the Fed is raising rates, mortgage rates tend to rise. As the Fed is cutting rates, mortgage rates tend to decline. And that's why we would like to see the Fed cut rates. So let's talk about the Fed here, because people hear about it, they mention it, it's in the news, but people don't understand it. I'd like you to make sure that you dive in and you really get this. Now, how many Fed members are there? Very few people know this, but there are 19 Fed members. Not all of them vote on whether we should cut or hike rates. That's called the Open Market Committee. So how many people are in that voting committee? Well, there are 12. So 19 members, 12 vote. So who votes? Of the 19 total members, the voting members always include the 7 governors. That's the Fed chairman and 7 people and 6 others that are called governors. They vote all the time. Now, what about the other 12 members of the 19? Well, the other 12 members of the 19, these are district presidents. You have them in Richmond, in New York, in Dallas, San Francisco, Minneapolis, Kansas City, Boston, all over the country. And these Fed presidents from these different districts, they will rotate into the remaining 5 voting slots. Remember, there's 12, 7 are taken up by governors. The other 5, well, the New York Fed president always votes. So that leaves 4 voting spots. So who votes in there? It's a rotation. You got the Cleveland Fed president, the Boston Fed president. They'll all kind of have different time periods or years that they'll vote. So who's voting this year? Let's see. Well, the new Fed chair coming in, Kevin Warsh, he's dovish. He's voting. And the New York Fed president, who always votes, is also a dove. Michelle Bowman, Chris Waller, one of the smartest people on the Fed, they are dovish and they always vote. Anna Paulson, she's the Philly Fed president. She will be a voter. Michael Barr, he's a governor. And Philip Jefferson, he's a governor. They're going to kind of monitor the data. They're not dovish. They're not hawkish. They're kind of centrist. Neil Kashkari is a voting member this year. He rotated in from Minneapolis. He is a centrist as well. Governor Lisa Cook, she's a bit more hawkish. So it's going to take a lot more to persuade her to vote for a cut. Beth Hammack, the Cleveland Fed president, and Lori Logan, the Dallas Fed president, they're rotated in as voting members this year. They're very, very hawkish. I don't know why they're so hawkish, but they are very, very hawkish. It's going to take a lot to get them to want to cut rates. But as you could see, you have more doves than hawks. So I think that as the first meeting that we're going to get under the new chairman Warsh in June, you will see a rate cut then. In fact, I think that you'll see through the course of the year likely 3 rate cuts, bringing the Fed funds rate from 3.625 to 2.875. Now, before we tie this all together, let's take a look at how this impacts real estate. Now, real estate, like anything else, it's going to be impacted by supply and demand. So as we look first at the demand side. So where does demand come from? It comes from households being formed. So if you have a mom, dad, and a child living in the same household, at some point in time, that child would get their own household. Now the family's still the same. It's mom, dad, and a child, but instead of one household, they now have two. So they've formed a household. So you can see we've been kind of forming households at around a 1.8 million clip based upon our level of population. But of late, notice how we've seen that fall down. So when we see something like this and we see that fall down, now this is very sensitive to interest rates. Interest rates have gone up, the amount of household formations declines. But as interest rates have reduced themselves, we've seen them bounce back up to 1.4 million. This is really pent up demand here, as you could see. So as soon as rates come down, demand pops up. Now, on the supply side, builders have been smart. They've been saying, hey, why would we build homes where there are people that are not going to go ahead and be able to meet that demand? We don't want to build homes that we're not going to be able to sell. So they've reduced the amount of supply to match the demand at 1.4 million. But here's the thing, is that we know that if interest rates drop, what occurs? Well, as you can see here, by pending home sales, rates drop, contracts go up. So we know that, went ahead of myself there. We know that going back, if we get to see demand increase, can supply keep up with that? I want you to think about that. This is what I'd like you to be able to understand so you could point out to your customer, because I think there's an opportunity here, right? So think about it. Can builders just suddenly match the amount of demand by increasing supply instantaneously? Because we know rates drop, boom, that demand picks up. But builders need time to build homes. And what happens, folks, when you have more demand than supply in any market? You have prices rise. So this is why we think that prices will appreciate in real estate, and why we need to explain this opportunity to our customers, because you might have some customers, especially on the real estate front, I would imagine some customers might say, well, if we think rates are going to drop, shouldn't I wait to take advantage of that? The answer is no, because you'd rather gain the appreciation than pay the appreciation. Here is a chart of the last 84 years of price appreciation in the United States. And when we look at price appreciation, I don't know another asset that has been so consistently showing positive results. And this period of time when we saw negative results, let's face it, mortgage underwriting guidelines got way too lax. We saw no income, no asset, no job, 580 credit score, zero down payment, investor property. I mean, it got crazy and it pulled forward too much demand. And then when the underwriting guidelines came back to more sensible levels, we had seen values take a hit. So as we look at the housing market forecasts, when we look at this, you'll see that the NAR is looking at 4%. Some others are more modest. Cotality is at 4.3. We see 3.5%. And I think that's a good level. But almost everyone sees the amount of transactions increasing, which I think is great for business. By the way, my Instagram handle's there. I put a lot of stuff up there. You're more than welcome to grab and take and copy and share. But one point about this, you see, when we look at 3% appreciation, let me just kind of talk with you about this for a second. The 3% appreciation, it might not seem exciting. And then somebody might say, why would I take money for a down payment out of my investment portfolio if my portfolio is making 10%? Now, that's not guaranteed either, right? 10% is pretty strong. But let's just say that logic's being used with your client as a real estate agent or a mortgage professional. Well, when we look at that, we have to say, okay, if you got 10%, and let's use real simple numbers. Let's say it was $10,000 that you were going to use for down payment. 10% on that $10,000, if you left it in your investment portfolio, that means you'd gain $1,000, right? It's 10% on $1,000. Okay, let's remember that. But what if you took it out and you used it for a down payment? I'm going to be very simplistic with the numbers here. And I know you can't get a home for $100,000, so this is just for conceptual purposes. A $100,000 home with a 10% down payment of $10,000. So you took the money out of your investment portfolio and you put it in there. Now, if that $100,000 home only went up by 3%, that still is $3,000. So your investment rose by $3,000, whereas if you left it, it only rose by $1,000. That's where 3% is greater than 10% because of the leverage that's involved. Now you might say, yeah, but I have a mortgage payment. True, but if you left it, you'd also have a rental payment. And I'll show you in a minute why they are kind of pretty close. Next, let's take a quick peek and go back to some slides here and pull them right back up. And I'm going to do it the same way where I can still come up on your screen. And let's take a look at a map of what you might be able to anticipate, because 3.5% is what we're looking at as appreciation. But if we look at inventory levels relative to the pandemic and kind of look at your marketplace here, you could see that in the Northeast, the amount of inventory relative to where we were pre-pandemic, boy, the Northeast is looking at levels here that are well below where we were before the pandemic. And that means that you'll probably get outsized appreciation, because I don't have to tell you this, you guys are on the front line. Inventories are still pretty darn tight if you're in the middle Atlantic and Northeast regions. And, you know, the Schiller Home Price Index came out and they recently said that we were only up in the 20 city index by 1.3%. It was higher in the overall nationwide numbers. But, you know, this 1.3%, it's being weighed down. That's on a yearly basis. And let me just show you what weighed it down. Notice in March, April, May, and June, the amount of appreciation for those months were slightly negative. So what happened there? Well, that's when interest rates were at 6.75% to 7.125%. But in August, as mortgage rates started to decline, a direct correlation. What happened here? Well, we see that as rates started to decline, prices started to rise. So this is an important understanding, an important distinction here, that there is a direct correlation here. If you looked at the last 4 months, prices are already appreciating on an annualized pace at 4.6%. In the past 3 months, 5.3%. So they're accelerating. Even more reason that now is a very good time for people to take action and buy and take advantage of that appreciation. So let's take a forecast for mortgage rates and see where they're headed here. Now, I've had the honor of meeting with Scott Besson a couple of times, and what he told me is, you know, he wants to unfreeze the housing market, and his target for the 10-year Treasury is 3.9%. Now, boy, don't look now, but we're pretty darn close to it. We're at 4.2% now, but that would mean that he sees the 10-year Treasury coming down even further and mortgage rates dropping further. But one of the factors he has to contend with is that we have a large deficit, and so we have to issue additional debt that's got to be absorbed by the market. But he has control over that additional debt being more short-term as opposed to long-term. But still, that short-term debt's got to be absorbed. Thanks to the Genius Act, stablecoin is definitely one of the things that will help. You see, stablecoin, it's a currency that's digital, but it, as the name suggests, has to be stable, which means as it becomes more and more utilized, more and more short-term treasuries have to be purchased to back it. So that will help absorb it. And the Fed, they reinstituted QE, and starting last month, they started buying short-term debt. That helps. And the purchases of MBS, and I can tell you I was pretty close to that, because being a board member of Fannie, it's great that Fannie and Freddie are purchasing mortgage-backed securities. That's helping mortgage rates come down. And then finally, if we get the Bank Deregulation Act to pass, let's hope it does, Scott Besson thinks that that's worth another 30 basis points in lower mortgage rates. That would be wonderful for us. So what would that be? let's explain the Bank Deregulation Act. Now, we all know how the banking system works, right? Banks borrow money from me and you. They pay very, very little to borrow that money from us. And then they either loan it out or they invest it at a higher yield and they make the spread. Wonderful. Now, theoretically, that means that banks, if they could take in as much money as they could, borrowing it cheaply and loaning it out or investing it at a higher yield, they could make an infinite amount of profit. But wait a minute, banks have to protect the depositors in case some of those loans go bad or some of those investments go bad. So how do they do that? They have to keep about 6% of what they take in and keep that on hand in cash so that if some of the loans go bad, the depositors will be protected. So an investment from a bank looks like this. If they took in deposits of $100 million, they have to keep in reserve cash, can't touch that, $6 million dead money, so they can loan out or invest $94 million. Now, let's say if they decided to take that $94 million and put it in treasuries, and they got, let's round it off and say 4%. That means they would get $3,760,000, or on the $100 million of deposit money, a benefit of 3.76%. Pretty good. But if bank deregulation passes, here's what bank deregulation would do. It says, hey, look, we still got to protect the depositors. And on all the investments, you still got to hold 6%, except if you invest in treasuries, because treasuries are guaranteed. It's no risk. It's backed by the full faith and credit of the U.S. government. So why do you need a reserve? That would mean an investment in treasuries would mean $100 million gets $100 million of investment instead of only $94 million. And if you invested at that same 4%, you get 4%. So you make $4 million instead of $3.76 million, giving you an extra $2.2 million. The idea here is that that would make treasuries a more attractive investment and create more buying of treasuries, bringing yields lower. That's why this would be great. Now, how low could they go? Well, I think 3.8% is very realistic. You could see where we've hit that several times here. 3.7, people can make a case for it. My dear friend Katie Stockton sees 3.67. My mentor, one of the smartest minds in economic history, Lacey Hunt, sees 3.6%. Look, all these would be good. So if the 10-year treasury gets there, we need to contemplate the mortgage spread. How much above that would mortgage rates go? So let's take a look at history of mortgage spreads. So once again, the 10-year treasury, then how much above that are 30-year fixed rate mortgages? That spread's known as the mortgage spread. So it's historically been between 1.6 and 2%. It's not an exact number, but that's been pretty historic. It went a little crazy after COVID, but then came down, and then you could see it went back up and it's coming down. So what governs this? What governs this is something called duration. You see, duration means the length that the life of a security would be. Well, a 10-year treasury, the life of it, that's easy. It's 10 years. But what's the life of a 30-year mortgage? Don't say 30 years because you know no one's ever held a mortgage for 30 years. So what's the life of it? Well, it's hard to price because some mortgages, they refinanced after 6 months or sold after a year. Some of them, they might have kept it for 5 years, 8 years, 12 years. It's very difficult to determine. But one thing that will drive it is the interest rate. So think about this. Someone with a 3% mortgage, what's their chance of refinancing? Not very well. Or even they'd be a little hesitant sometimes to move too, right? So that means the duration of that is longer, meaning that there's more servicing value and it becomes more valuable and it behaves more like a 10-year treasury. So the spread's lower. And you could see it happened here in 2001 and 2002 when the Fed pushed rates all the way down. Well, the chances of those refinancing or paying off became less. We knew that there'd be a longer duration, so they behaved closer to a 10-year treasury. The spread's lower. But as the Fed pumped rates up and we started quantitative tightening, mortgage rates went up to 8%. Well, the spread went up because those 8% loans, people are itching to get out of that thing, and many have already had gotten out of that thing. But as the rates have come back down towards, let's call it 6% now, the spreads have come in more in line with reality. and they probably will stay within here. So now that if we could say, okay, well, if mortgage spreads are more in line, now we can give you a good forecast for mortgage rates. If we think the 10-year Treasury gets to 3.8, and we think mortgage rates, the spread narrows to a more normal in between the historical range of 1.6 and 2, and let's call it right in the middle at 1.8, we could tell you that it seems like a 30-year fixed rate mortgage should come to a target of around 5.6. Now, look, I wouldn't be surprised at 5.5. I wouldn't be surprised if it goes a little bit to the upside because things change to 5.75 of 5.875. That is a realistic forecast. Now, how does this stack up? Well, as you can see, we're kind of on the low end. And I'm comfortable being here. And in fact, we ticked already below 6%. So all of these forecasts are already wrong. So we are, I think, likely to see this forecast come pretty close to our target. As I said, exacts are tough. But I think in the range of these lower numbers, many of these targets, I think, are way too high. Let's talk about net worth. Care about that for ourselves, but we care about it for our customers, because what we should look at ourselves as not someone who's selling, but someone whose job is to create net worth for our people. And the top 1% of net worth in the United States, $11.6 million. That's a big number, certainly. Top 2% comes down a lot to $2.7 million. Top 5%, $1.2 million. Top 10%, $900,000. And the top half of our country, it's at $600,000. So what's important about this is that 2/3 of all net worth comes from home equity. And the average net worth of a homeowner is 44 times that of a renter. See, it's very difficult to be wealthy without real estate. So the next time somebody says, hey, or they listen to somebody in the media say, hey, it's cheaper to rent. Well, not really. That might be temporarily cheaper on a monthly basis, but longer term, a wealth creator is real estate. And look, let's just make a comparison the right way on buying versus renting. People just look at the payment. They say it's cheaper to rent. But let's look at this carefully. As we see here, we could see that a purchase price, if we took an example of $600,000, the loan amount on a 90% loan to value would be $540,000. Let's take a 30-year fixed rate that's much higher than the market. So I'm going to make this ugly, make it an expensive mortgage rate of 6 3/8. And let's say that would give you a mortgage payment of $4,800, and you could rent the same property $800 a month cheaper. Well, somebody's going to say, hey, man, it's a no-brainer. It's $800 a month cheaper. It's too expensive to buy. Let's rent. But that's going to be something that you have to think about, because rents would go up. Remember renewal rents? They're going up on renewals at 3% per year because, it's a pain in the butt to move, and the landlord's got some pricing pressure. It's expensive to move, so they do that. Now, if they think they're going to be in this home for 9 years, well, let's take about the negative. See, I always like doing this with clients. I'm not going to try and sell you. Let's look at all of the potholes that are out there. Look, if you buy this home, I want you to consider these 3 things. And I think you should all do this with your customers. Very valuable. Number one, I want you to think about this. Your property taxes will likely go up. And let's figure in 2% a year when we evaluate this. Another thing about home ownership is repairs. The landlord would be picking up repairs where now those are on you. So let's estimate about $4,000 a year to make sure that we are fairly evaluating this. And then, hey, look, the cost to sell too, based upon the appreciated value. Let's factor in 5% cost to sell. So once we factored all that in, now let's look at the positive of buying. There's lots of them, but one big one, man, that's the level of appreciation. And if we take a look at the last 63 years in you guys' market area, it's been 4.2%. And the forecast for the next 9 years is just a hair under 4%, which is very meaningful. Let's break it down. Now, as I mentioned to you, you're going to be paying $4,800 to buy, $4,000 to rent, and it seems like it's cheaper, but that's only the first year, and that doesn't take into account principal. See, principal's building. I want to show you the difference here, team. You see, let's look at year one. This column here, that's buying. The column on the left is renting. So yeah, it's $4,800 to buy, $4,000 to rent. So it seems like it's more expensive, but $500 of that $800 difference, that's your own money. See, that's the black section here that you see. So by year two, it's almost even. By year three, when you consider it's your own money, you're actually cheaper in your monthly payment buying versus renting when you calculate that this is just for savings that grows. Now, what I'd also like you to see is that rent's going up every year. So eventually the rent gets more expensive. The amount of principal that you're gaining in year one is $6,000, but after 9 years, it's $72,000. Yeah, that's a lot of forced savings and wealth creation there. That's my job, to create wealth for you, right? You started with a 540 mortgage. 9 years later, you owe 467. You made almost $73,000 in amortization and forced savings by buying the home. But then the big one is, remember that 3.96% appreciation? Yeah, that home value, it's going to go from 600,000 to 851. You could do the math. Albert Einstein said the eighth wonder of the world is it's compound interest. That's $251,000 gain. And then the tax benefit that you get above the tax benefit you get from renting, because you still do get a small tax benefit from renting, is another 19,000. But when it comes time to sell, 5% of that appreciated $851,000 value is you'd lose $42,000 in that. So what's the grand total benefit buying versus renting? Well, it's $254,000. And that's why you have to look at this over time. Now, look, if you're going to be moving in 1 year, rent. But if you're going to be there 2 years or longer, you should be purchasing this home. And that's the right way to look at it. Now, how about those people that say, well, maybe I should wait? And by the way, Atlantic Bay does the best job of putting this together. And at a moment's notice, if you ask your Atlantic Bay teammate, they will have this comparison specific to your buyer, specific with the appreciation in that forecasted zip code, down to the zip code. But they will give you this information. And they'll also help you with the client who says to you, maybe I'll wait for rates to come down. I'm sure as a real estate agent, you have people waiting. Well, Atlantic Bay has the answer to that, because look, we hear it about marry the home and date the rate, but it's just a cute saying until Atlantic Bay explains mathematically specific to the zip code that you're in, how this can benefit you. So let's take a specific example. The property value is $700,000. And let's say specific to that zip code, that home, the forecasted appreciation for the next year is 3.5%. If they're going to put 20% down, that's a $560,000 mortgage. So again, I'm going to say the rate's even higher, 6.25%. And they're waiting for rates to come down 0.5%. So it might take time. Let's just say it takes a year for that to come down. But if you buy now and you buy at the higher rate, how much higher would your monthly payment be? It would cost you an extra $180 a month. So Barry, you're telling me I got to pay $180 a month. If it takes a year, that's 12 months. That's $2,000 more in mortgage payments. Yeah, it gets worse, because then to refinance to the lower rate, you got to spend, I don't know, let's pick a number, $4,000. So the disadvantage of buying now is $6,000 maximum to date the rate. But what about the advantage of marrying the home? See, nobody looks at that. And based upon the value of the home at $700,000 at 3.5%, that's why, thankfully, Atlantic Bay does this and shows this, because the client, sure enough, doesn't. That's a $24,000 benefit minus the $6,000 cost maximum to date the rate based upon extra carrying costs for the higher rate temporarily and the cost to refinance. You're still ahead by $18,000. See, that's why you marry the home and date the rate. And again, you can show this in a co-branded way instantaneously. Your Atlantic Bay teammate will do this for you. And look, Atlantic Bay has been very successful in managing this professionally, because here's been the last 2.5 years where you could see, 3 years, where you can see there's been opportunities where yields have dropped, and they have had opportunities to refinance that customer down to a lower rate. But meanwhile, in the last 3 years, home values in your market, they've gone up 15% in 3 years. So what does that mean? That means if they bought a $500,000 home, they've made $75,000. Think about that wealth creation. That's why the two of you guys teaming up makes sense. But the other thing Atlantic Bay does with the clients that's extraordinary is they create a strike rate. You see, other mortgage professionals at the day of closing, that's when they stop. But no, Atlantic Bay has a system where what they do is with every client, they will come up with something called a strike rate. And that strike rate, what it says is, okay, every day from closing, we're going to be monitoring this for you. And as rates improve to a level where we can refinance you, give us a number, we'll convert it to a rate. And just like a stockbroker, they'll execute it. So if the customer says, I want to save $250 a month, when it hits that opportunity, they have a list. And they also have the ability, because they'll be able to see when not only the rate hits that, but when they can remove mortgage insurance based upon they're calculating every month the appraised value of that property and the amortization on that property. So they'll notify that customer and save them money. This is why Atlantic Base stands head and shoulders above everyone. And what they offer you too as a real estate agent is the ability, free of charge, to get on Home Report. Now, Home Report is opened 82.4% of emails. What email gets opened 82.4% of the time? And that's because Home Report tells them what their current value is. It tells them what the forecasted value is. And this is something you could upload your entire database as a realtor and have your clients get this valuable report, which not only does it do that, but let me show you what else it does. It shows people how they could save money with a refinance as well by automatically calculating that for them. So you're working to save them money. But here's the big plus. It asks them what's their likelihood of moving. And the customer notifies us. So you get notified so that nobody steals your client away from you. And in addition to that, they get teased with active listings that stay in their environment, not on Zillow where somebody else could market to them. You want them to stay in your own environment as a realtor and mortgage professional, and they could put in any zip code and in a safe environment, they could shop it. But as they do, you both can monitor their activities and you can get notifications that, hey, they looked at this property 6 times. Maybe you should call them. This is why you want to do this. And clearly, if you want to stay in touch with me, as I said, you could get that QR code, or you could just go to like Instagram and I am Barry Habib. Guys, I can't believe that we were able to come in right on time. I know that makes it a little tight for questions, but there's always time for me to take a couple, 2 or 3.
Thanks, Barry. I guess someone's going to come with some questions. I just want to say every year I just love the buy versus rent and how simply you can make that. I mean, I think that especially, the younger generation don't realize what a wealth builder that is and how you can simplify that. Just it's great. So any questions from, I know we have quite a few. So Bill, do you want to pick?
Yeah. I know that we've got one that Barry is, do you expect first-time homebuyer activity to increase or decrease this year?
So you have to remember the media makes a big thing of it, but for the past several years, it has remained between 27 and 33% of the market, and it fluctuates greatly within that range. And I know Diana Olick said, the first time it's down to 27%. And then the next month it bounces up to 33 and she doesn't say anything because it doesn't get clicks. So be careful with the media. She'll also say the historic average is 40%. No, it is not. Okay. Maybe in the 1980s or 90s, but people wait longer to get married. They wait longer to have kids. And as a result, they wait longer to purchase a home. Now, remember, there's also a stat that you hear that's saying people are now first-time home buyers. The median age is 40. Be very careful with that. There are 6 different surveys. 5 of the 6 show it's between 34 and 35. One said 40. I think that's the outlier, but that's the one the media likes to quote. So look, could it be that high? Maybe, but I think closer to 34, 35 is the right number there, and we should be aware of that. So I do think as rates drop and affordability improves, a natural inclination would be for people to increase activity for first-time home buyers.
And Barry and Emily, if you have anything after this one, feel free to jump in. But a lot of our team is very focused on builders, and with so much around affordability and bent up inventory, where do you see the construction market kind of going? Is that going to be is that what it will resolve the lack of inventory?
Yeah, I do think inventory will remain tight, especially since I believe rates will drop and it'll increase demand. Now, we wish there were a little more inventory. I get you, but that's just kind of going to be the nature of things. But what we can do is how do we advise our customers accordingly? And that would be to take advantage of the anticipated greater imbalance in inventory in the future by making sure you do your purchases now, so you take advantage of that anticipated appreciation that should result from it.
Here's one swinging for the fences. This question comes from parts unknown, but the big word being affordability. Is there an expectation, or in your crystal ball, are you seeing something that that new home buyers get some relief, or the affordability picture becomes better for them?
The answer is time, and that's because incomes do tend to go up over time. I mean, look, all of us could probably remember, and those of us who have purchased a home. I'm a baby boomer, so I'm a little older. So those memories are very, very clear for me of, the first home and the second home that I bought. It always seemed like it was a bit of a stretch when you first made that purchase, right? And then something happens over time. Those mortgage payments, if I reflect on what they were, boy, they seem tiny compared to what people are looking at now. So I think time fixes that. It says we're all impatient. So as incomes go up, look, here's what's happened. Before, you had incomes going up, but the rate of inflation at 9% was faster than incomes were growing up. So our lives were under a lot more pressure financially. But now, yes, there is inflation, but incomes are going up at a rate that is greater than inflation. And once you have a mortgage and you lock in that mortgage rate, then that stays here while your income goes up, making it more comfortable for that payment. So that's a key point to stress with customers, is that it might be a stretch. It might be uncomfortable initially, but time fixes that. And with affordability, the biggest fix rapidly will be rates. The biggest fix over time will be incomes rising.
Fantastic. Emily, I'll turn it over to you.
We appreciate it, Barry. Thank you so much for being here. Thanks to all of our guests that joined us today. I love how you put this in terms that I think everyone can understand and really break it down. So I think it's been awesome.
Hey, you guys are the greatest. I mean, much love to all of you. God bless all of you guys. It's such a pleasure to be here. Great luck and a great year ahead. It's going to be a good one. Look for some good things to be coming your way. Expect good things to happen.
Yes.
Thanks, Barry. Take care.
Thanks, Barry.
Thanks, everybody. Appreciate
For everybody
it.
watching, be expecting the recording will be out next week. We hope to have it to you by next Friday. So you'll be able to rewatch this and get even more information to go back and check your notes. Thanks, everybody.
Thanks. Take care. See you guys soon.